Hello, it's a lovely good morning from here in Delhi as always, and hope that each one of you are absolutely fine. So, now in this particular session, we are starting a pretty simple chapter after having what we call wrapped off valuation of goodwill. Now, we are moving over to valuation of share. And now, even this particular chapter at your level is given in a very elementary manner, to be very honest with you. But in spite of that, because it's a part of syllabus, so we have to do it, and we are going to do it. So here we go and start this particular chapter. Valuation of shares. That's the topic. That's the chapter which we are going to now start in a short while. Valuation of shares. I have already written the title. Now, as far as valuation of shares is concerned, quite obviously, suppose I have invested my money in a particular company, correct? If I have invested my money in a particular company, then let me actually just adjust the lightings a bit, correct? So, well, I was talking about this particular fact. Suppose if I have invested in a particular company, obviously, why I invest? One reason is that actually, basically, I am interested in having some income out of that. In fact, to be very honest with you, most of the investors have this intention to earn some income by way of their investments, correct? And at the same time, that income could be in the form of dividend, as I said. And many people actually invest in an entity just for the purpose of not only just earning income, but the moment any benefit arises in the sense means, suppose I have invested in a particular entity and right now I purchase the share, let us say at the rate of 20, and just after a month the price per share of that particular entity's share I'm talking about has gone up to say 30, 40. So I may be tempted to sell my shares. That means here my intention is to earn quick bucks. So there are basically two types of intentions. One, I just want to hold down my shares, keep on earning the what we call income for a prolonged period of time. Then there is an intention that I should make a quick money by trading in the shares, correct? That means I am holding down the share just for the fact that the moment the price in the market would rise, I am going to what we call dispose it of. So besides that, there is another intention for valuation of shares. Why we value the shares? Quite obviously, as I said, because I have invested. So I'm interested in knowing actually what price these shares can fetch me. As I just said a moment ago, one intention is to earn income. Suppose I'm interested today in selling my shares. Quite obviously, I'm interested in knowing what price my share can fetch to me. If suppose I am having 1000 share, and through calculation I come to know that per share can be sold in the market at the rate of 25. So this way I can estimate that 1000 into 25 I will get by what we call disposing of my shares. On the other hand, there is another intention for valuation of shares. Let us say I am a very heavy investor. I have invested very heavily in a particular entity. Because my investment is in bigger lots, quite obviously I am quite concerned with respect to my investments. So at a particular point of time, say I'm interested in knowing what exactly is the situation of that particular company, or should I say, what exactly is the situation of my investment, because I have invested very heavily in that particular company. I want to know whether my investment is safe or not. Are you getting my point? So there is another intention to value the share. Accordingly, on the basis of these intentions, there are several methods for valuation of shares. However, first of all, we will see that there are two broad methods. We'll talk about others too, but there are two broad methods. One method is known as what we call net assets method, and each one of you have heard about it. It is also known as assets backing method. And another method is known as earning per share method. Commonly, sometimes people call it yield method too. So one by one, we are going to discuss all these things. So here we go and discuss. So as I said, there are two broad methods. One is known as assets backing method. Assets backing method. First, we shall talk about this assets backing method. Assets backing method. It is also known as net assets method. In fact, you have already done it so many times. Assets backing method or net assets method. Generally, this methodology is adopted by such investors who have invested very heavily in a particular entity. Correct? So I write here generally this method is adopted. This method is adopted by investors who have invested heavily or heavy amounts in shares. So generally this methodology is adopted by investors who have invested large amount, correct? They are more concerned with the safety of what we call their money. Such investors are more concerned with safety of their investment. Obviously, because I have invested very heavy amount, I am concerned about this particular fact, whether my investment is safe or not. Such investors are more concerned with safety of their investments. Then how they would actually find out whether their investment is safe or not? They will compute intrinsic value of share through net assets method, or what we call assets backing method. Such shareholders, or such investors, I should write, such investors are interested in intrinsic value. You have heard this particular word. If you remember, under business combination, we used it so many times. So such investors are interested in intrinsic value. Intrinsic value. Generally, we call it IVS, intrinsic value of shares. So such investors are interested in intrinsic value of shares. Intrinsic value of the shares simply tells what worth of assets are backing your what we call worth of share. What I mean to say, suppose if I have purchased rupees 10 shares of a particular company, one share is of rupees 10, and intrinsic value, let us say, is more than 10, it means my investment is safe. That means in order to back 10, company is having what we call more than 10 assets to back up my investment. So it means my investment will be safe. So such investors are interested in intrinsic value of shares. So now the next question is how intrinsic value of shares is computed. IVS is computed through net assets method or assets backing method. Through net assets method assets backing method. Assets backing method. How to compute? Just pay attention. Methodology or steps. In order to compute what we call intrinsic value of share, what we require, we will consider all assets. And please pay attention, because now we are not doing the valuation of goodwill. In case of valuation of goodwill, I did tell that we never take non-trade investments, and we never take, as I said, what we call any non-operating assets. But while computing intrinsic value of shares, whenever we are going to take assets, we'll include non-trade investment also. Besides that, we will include even non-operating assets. Correct? So that is why I will write here all assets, including non-trade investments, non-trading investments, and non-operating assets. Non-operating asset. I gave you the example in case of valuation of goodwill. Non-operating asset means, for example, a piece of land which we have purchased, but we are not using it for business purpose. Rather, we are holding it down for the purpose of sale. So in that case, it is considered as non-operating asset, and non-operating asset are generally not considered as part of what we call assets in the context of goodwill. But here, and almost everywhere, barring goodwill, everywhere non-trading investment and non-operating asset will be included under asset. Non-trading investment and non-operating assets. So all assets we will consider, excluding, however, we never consider valueless assets, because valueless assets are not considered assets at all. Excluding valueless assets. Valueless assets means preliminary expenses, underwriting commission. Valueless assets, or fictitious asset as you call it. So valueless assets are not considered as asset, so they will not be included. So we will consider all assets. Correct? And from there on, we shall then subtract all liabilities less all liabilities when I say all liabilities, it means external liabilities, sundry creditor, bills payable, outstanding expenses, etc. Then each one of us know what we get by subtracting liabilities. Correct? By subtracting liabilities from asset, we get net assets. And so many times I have already told you, net assets is also known as capital employed. It is also known as assets available for shares. Assets available for shareholders. Now, if there would be any preference share capital, then we will subtract here claims of preference shareholders. Claims of preference shareholders. Preference shareholders. If there would be any preference share capital, then you are going to subtract their claims. Their claims means a preference share capital besides arrears of preference dividend. Arrears of preference dividend. If there are any arrears, you are going to subtract it. So this total makes preference shareholders claim. So if there is any preference share capital, you will have to subtract from the assets available for shareholders. Now you would get assets available for equity share. Assets available for equity shareholders. Equity shareholders. So now you will get assets available for equity shareholders. Once you get that, then all you need to do is to divide it by number of equity shares. Number of equity shares. You divide it by number of equity shares. By dividing it by number of equity shares, what we get? We get intrinsic value of share. We get IVS. IVS, if it is more than face value of share, that means your investment is safe, and if it is not, then your investment is not safe. Are you getting my point or not? Before I move over to other part, let me actually explain. We have computed net assets very easily here. Suppose in the question, sometime assets and liabilities are not given, then how will you compute assets available for shareholders? That is important point to understand. See here, try to understand this point. Suppose this is the balance sheet of a particular company, just for a while. Let us say in the balance sheet there is property, plant and equipment, PPE, that is fixed asset. Let us say fixed asset are worth rupees 5 lakhs. Let us say there are current assets to the extent of, let us say 8 lakhs. And we presume for a while there are some valueless asset, VLA, like preliminary expense, underwriting commission, etc. Valueless asset, let us say, are 1 lakh. Correct? For simplicity's sake, we are taking only 3 items towards the asset side. 14 lakh is the total, I think so, isn't it? Now, I move over to the liability side. In the liability side, let us say there are liabilities, that is long term and short term, non-current and current liability. Let us say liability is equal to 8 lakhs. Just wait. Liability is equal to, let us say, 10 lakhs. Just wait, let me think. I will make it 6 lakhs. Liability is equal to 6 lakhs. Besides, let us say there are items of other equity. Other equity means reserves and surplus. Let us say there are some reserves to the extent of 2 lakh. Correct? And let us say equity share capital. Equity share capital is 4 lakhs. And one share is of 10 each. Correct? That is 10, 12. And there is 10% preference share capital. 10% preference share capital, let us say again it is of 2 lakhs. Suppose if I ask you, through this balance sheet, compute assets available for equity share, how will you compute? Assets available for equity shares, in order to compute assets because that is the fulcrum. By having assets available for equity shares, all we need now is number of equity share and we'll divide it to get intrinsic value. So assets available for equity shares, in fact, I'm interested in computing assets available for equity shares so that I am in a position to compute intrinsic value of share. In order to compute assets available for equity share, just a moment I told you we will consider all assets. So I will consider property, plant and equipment, and property, plant and equipment, as you can see, is 5 lakhs. So I will write here 5 lakhs, correct? Then besides that, we shall consider current asset, and current asset in this case is 8 lakhs. I have already told you valueless asset, that is fictitious asset, are not considered as an asset. So total of my asset is 13 lakhs. If there would have been any revised value, I would have considered that. Remember one thing. Then I will subtract the liabilities, all the external liabilities. So liability generally stands for external liability, which happens to be in this case 6 lakhs. So I'm left up with how much? 7 lakh. What is this 7 lakh? This 7 lakh is assets available for shareholders. It is known as assets for shareholders, correct? Assets available for shareholders. Now you have computed assets available for shareholders. Just have a look. Is there any preference share capital? Yes. In this case, there happens to be a preference share capital. So preference share capital, you will subtract. Preference shareholders claim will be considered 2 lakh. There are no arrears of dividend. So what I get? I get 5 lakh. This 5 lakh will be considered as assets available for equity shares. It will be considered as assets for equity shares without any iota of doubt. Now, in order to compute intrinsic value of shares, all we need is assets available for equity shares, and we are going to divide it by what we call number of equity share, isn't it? So in order to compute intrinsic value of share, we need assets available for equity share, which is 5 lakh, and we need number of equity share. Number of equity share in this case is 40,000. So if I divide 5 lakh by 40,000, calculator is lying here. Just wait for a moment. Here it is. So 5 lakh, 12.5 I think it will be. Right, it is. So intrinsic value is rupees 12.5. It means your investment is absolutely safe. As a shareholder, your share is having a face value of 10. Suppose today this company gets liquidated. Still your investment is safe because your company is in a position to pay each share of 10 each at least 12.50 worth of assets. That is why I am saying that intrinsic value of shares signifies the capability of the company to honor your investment or not, especially in times of crisis. Now, but my discussion was not with respect to the worth of intrinsic value of share. My discussion was, often we may find in the question that balance sheet is not available. And question may ask us to compute what we call intrinsic value of share. So how under those circumstances you are going to compute intrinsic value of shares? That's the moot point. So you need to know that assets available for equity shares can be computed this way, and assets available for equity share can be computed this way also. And generally this methodology you should adopt only when balance sheet is not given. When balance sheet is given, always go through this particular what we call methodology, correct? Assets for equity share. Assets for equity share holders can also be computed this way around. Just have a look here. Just have a look here. Just have a look here. 1 lakh, 2 lakh, 3 lakh, 4 lakh, 5 lakh, 6 lakh, 7 lakh, 8 lakh, 9 lakh, 10 lakh, 11 lakh, 12 lakh, 13 lakh, 14 lakh, 15 lakh, 16 lakh, 17 lakh, 18 lakh, 19 lakh, 20 lakh, 21 lakh, 22 lakh, 23 lakh, 24 lakh, 25 lakh, 26 lakh, 27 lakh, 28 lakh, 29 lakh, 30 lakh, 31 lakh, 32 lakh, 33 lakh, 34 lakh, 35 lakh, 36 lakh, 37 lakh, 38 lakh, 39 lakh, 40 lakh, 41 lakh, 42 lakh, 43 lakh, 44 lakh, 45 lakh, 46 lakh, 47 lakh, 48 lakh, 49 lakh, 50 lakh, 51 lakh, 52 lakh, 53 lakh, 54 lakh, 55 lakh, 56 lakh, 57 lakh, 58 lakh, 59 lakh, 60 lakh, 61 lakh, 62 lakh, 63 lakh, 64 See, in order to compute assets available for equity share, we have taken property, plant and equipment, current asset and liabilities. That means we are left up with now these items: equity share capital, reserves and valueless asset. So with the help of these items, we can also compute assets available for equity shares. How we can compute? See here. I will write equity share capital. Equity share capital is 4 lakh. I will write preference share capital. Preference share capital is 2 lakh. I will write reserves because reserves is also considered as part of equity. Reserves belongs to owners. 2 lakhs. If reserves belong to owners, then valueless assets also belongs to owners. So valueless asset is a sort of loss, you can say. So less valueless asset. Valueless asset is 1 lakh. Now you can see that assets available for shareholders we can get now 7 lakh. This 7 lakh is actually assets available for shareholder because we have written here preference share capital also. So it will be assets available for shareholders. This is your asset available for shareholders. Is it clear to you or not? Once you have computed this part, then all you need to do in order to find out assets available for equity shares, you need to subtract preference share capital. Now assets available for equity share is 5 lakh, as you can see. So it is also known as liability side approach, correct? So now you can get assets for equity shares. Assets for equity shareholders. So you can get assets available for equity shares. You got my point. In fact, suppose balance sheet is not given. In that case, it is better not to include preference share capital. Directly take equity share capital, reserve and valueless asset, and you can directly what we call get assets available for equity share. Is it clear to you or not? So if you have done this particular method, now first we will pick up some questions on the basis of this method before we attempt the other part. Is it clear to you or not? Correct? So after getting a look and insight into this one, now it's time to actually pick up some questions. So for the same, I pick up question number. First of all, we'll begin with question number 2. Question number 2. Question number 2 says, following is the balance sheet of Hip Hop Limited. And in the balance sheet, you can see we have 10,000 12% preference shares of rupees 1 lakh. Besides 30,000 equity shares of 10 each, 3 lakh. Then we have general reserve, debenture redemption fund. Now, debenture redemption fund is considered as a free reserve. It is not considered as a liability. Remember one thing, correct? It is an appropriation. So it is not considered as a liability. However, you have 3 liability: notes payable, 10% debentures and sundry creditors. You have 3 liability. Besides, you have sundry assets, preliminary expenses, discount on issue of debenture are valueless asset, and profit and loss account is written towards the asset side. However, nowadays actually profit and loss account is not written towards the debit side, that is towards the asset side. Rather, it is shown as an item of subtraction. But anyway, because we have been given question this way, so we have to move accordingly. So it is also a sort of valueless asset. It is an accumulated loss. In fact, all these 3 items are not assets. Now question states below that debenture interest is owing for 6 months. So debenture interest is outstanding. 10% debentures are there, 6% interest is outstanding. And question also states that dividend on preference share are in arrear for 1 year. So 1 year, if the question states clearly that there are some arrears of dividend, then only you will consider the arrear of preference dividend. Now, assuming the assets are worth their book value, so question has stated very clearly that whatever book value, correct, that is the real value, show the approximate valuation of shares. Now, below question has asked two things. I will explain these two things also, but let me compute what we call, in this case, intrinsic value of share. In order to compute, question number 2, first of all, we are picking up. In order to compute the intrinsic value of share, what we are going to do, first of all, I am going to compute assets available for equity share. Obviously, assets available for equity share can be found out, very easily. So, I take sundry assets. Revised value is not available, so I will simply take 5,48,000. I've already told you rest of the items towards the asset side are not assets, so we are not going to consider those. Now I'm going to subtract from here 3 liabilities which we are having. One is notes payable. Now notes payable, as you can see, is 15,000, so I will subtract 15,000. Besides, we have 10% debentures. So 10% debentures I will write. 10% debenture in this case happens to be 50,000. Then we have sundry creditors. Sundry creditors are 95,000. However, you shouldn't forget writing interest on debenture outstanding. Interest on debenture outstanding. It is also a liability. Interest on debenture outstanding for 6 months. 50,000 is your amount of debenture on which debenture holder will get 10% interest for 6 months. That will be 2,500. So 2,500. So by subtracting what we call these items from 5,48,000, what we get I did not require to tell you. It is 3,85,500, and it will be your assets available for shareholders. It is known as net assets. It is known as assets available for shareholders. Once you have assets for shareholders, from there on you will subtract preference shareholders claim. Preference shareholders claim. Now preference shareholders claim are in the form of preference share capital. Preference share capital is 1 lakh. A. Preference share capital, which is 1 lakh given to you. Correct? Besides, you have arrears of dividend in this question. So arrears of dividend. Arrears of dividend. Now question has cited that 1 year's dividend is remaining. Rate of dividend is 12%. Preference share capital is worth 1 lakh. So 1 year dividend will be equal to 12,000. So preference shareholders claim 1,12,000. We shall subtract. We shall subtract. Correct? Generally, actually these are the assets available for shareholder. Try to understand the logic. Suppose this company gets liquidated. So our sundry asset will realized at this value, and from this realization will pay off our liability. So this amount belongs to shareholders. Now the amount which belongs to shareholder, generally preference shareholder has a preferential right over this amount. So that is why we always subtract preference shareholders claim first. Now remaining amount belongs to equity shareholders. So we call it assets available for equity shares. Assets for equity shares or equity shareholders. You subtract this figure, you will get 2,73,500. 2,73,500. So now you are in a position to find out intrinsic value of share. Assets available for equity shares are already with you. Now you divide it by number of equity shares. Number of equity shares, 30,000 shares is already given in the question. So 2,73,500 divided by 30,000, you get 9.12 approximately. It means this value which we are getting, and mostly we will compute intrinsic value this way around only. However, in this question, this is answer number 1. Why? Because question is stated, find out the value if preference shares are preferential as to capital and arrears of dividend are payable in winding up. Indirectly, it means if preference shareholder has a preferential claim. And later on, question states that if preference shares are preferential as to capital, but arrears are not payable. In the second case, say here, in the second case, this is your answer to first part, correct? This is answer to the first part of the question. If you want to deliver the answer to second part, first of all, you will have to compute assets available for shareholder, and you will compute that way only. From asset, you will subtract the liabilities, so you will compute assets for shareholders, which is 3,85,500 as we know. Now, in part 2, question state that preference shareholder are preferential but only with respect to capital. So, in second case, when I will subtract preference shareholders claim, I will not subtract arrears of dividend. I will subtract only preference share capital, which is 1 lakh. Just to ask, question may tilt this way, correct? Just to test you, in fact, examiner may twist the question this way, whether you are able to understand it or not. However, in practical life, it is never done. Preference shareholder are always preferential with respect to capital and dividend. But because question is asking this way, so we have to answer it that way around. So 2,85,500 in this case will be considered, 2,85,500 will be considered assets available for equity shares. It will be assets for equity shares. Now you will divide it by number of equity share. Obviously, in this case, your intrinsic value will be a bit higher, because this time asset available for equity shareholders are higher. So 9.52 approximately it will be. This is your intrinsic value of share, correct? In the upcoming session, we'll continue with this topic. Of course, this question is over, but we'll still pick up some more question on this particular topic.